Good morning or good afternoon, depending on where you're located. Thanks for joining us today. And I'm excited to present some fantastic material that we've prepared for you. And thank you for all of those who have started introducing themselves in the chat. It's nice to know who's attending this event and what you all are looking for. So today's presentation focuses on reducing your supply chain climate risk with GHG assurance. We'll do a formal introduction in a second, but my name is Brady Koetting. I work for KERAMIDA, a global sustainability consulting firm, and joining me is Farheen Altaf from CDP. Today's session, we're going to highlight the tangible benefits and strategic importance of having your emissions, and specifically your Scope 3 emissions, assured by a third party. We look forward to an engaging discussion and sharing valuable insights that can empower your organization in navigating the complexities of upcoming regulations and shareholder expectations. Let's begin. And as I mentioned just a few minutes ago, if you have any questions that come up throughout this presentation, feel free to throw them in the chat and we'll try to address them at the end. So as I mentioned, my name is Brady Koetting. I'm a Senior Sustainability Assurance Manager at KERAMIDA Incorporated. My background is primarily as a CPA, so in a prior life, I did financial audits for both public and private companies at a Big Four firm. Since then, I moved over to the sustainability world, focusing primarily on GHG assurance and helping our clients meet the growing list of regulations around the world. Now I'll turn it over to Farheen to introduce herself.
Thanks, Brady, and hello, everyone. My name is Farheen Altaf. I'm a Senior Climate Accounting and Standards Manager at CDP. Over the course of my 4.5 years here, I have worked to design the CDP corporate climate questionnaires, support companies in their disclosures to ensure they are accurate and of a high quality, generate insights from data reported to us, and set the future direction of our questionnaires, ensuring they continue to drive ambition and climate action while aligning with the key emerging disclosure standards. Now I'll hand back to you, Brady, to talk about the work that you do at KERAMIDA.
Great, thanks. So these on the screen are just a few of the accreditations and certifications that KERAMIDA is proud of obtaining, including being a woman-owned business and one of the only few CDP Gold level ASPs for verification. A lot of our clients come to us because they're already familiar with CDP and they want to improve their CDP score through verification, so they'll find us on the website, and we certainly love our partnership with CDP. KERAMIDA is headquartered in Indianapolis, but we have clients and analysts around the world. Today's presentation is centered around assurance and verification, which we certainly do a lot of, but we also assist companies in complying with regulations like CSRD or preparing voluntary disclosures. We're proud that our team is multidisciplinary to ensure that we are equipped with any of our clients' needs, with our teams ranging from CPAs, such as myself, to engineers and scientists to provide a holistic approach to any project. Now I'll turn it over to Farheen to talk a little bit about CDP and their reach around the world.
The CDP runs the world's environmental disclosure system for companies, cities, states, and regions. With over 23,000 companies disclosing to us in 2023, our data represents the environmental performance of companies worth 2/3 of global market capitalization. This data empowers investors with $142 trillion of assets to make investment decisions that support climate action. And that's why ensuring that this data is of a high quality and credible is crucial. Handing back to you, Brady.
Thanks. So with all the introductions finally out of the way, this is the agenda of the items we're going to be covering. We will be discussing what are supply chain climate risks and how should it be addressed, increasing demand for quality verified emissions data, the benefits of assurance for your supply chain data, and then benefits of requiring verification from your supply chain. So we're going to be covering all of this information from a lot of angles, how Your information will feed into other people's scope 3 and how your suppliers feed into your scope 3. Hopefully this will be insightful for everyone on the call. So before we get much farther, what are the supply chain risks that we're referencing here? The first thing that many of you probably already know is that scope 1 and scope 2 emissions typically make up only a very small portion of your company's total emissions profile. For most companies, nearly 90% of their emissions relate to scope 3, with most of those belonging to category 1, also known as purchased goods and services, or the emissions that are created from what you purchase from your suppliers. Well, scope 1 and 2 are typically straightforward because the data is already available within your company. If you think about, natural gas invoices or electricity invoices, those are usually pretty readily available already. Scope 3 is much trickier because it often relies on obtaining data from outside of your organization. In addition, because scope 3 makes up such a large portion of a company's emissions, it's vital that your calculation of scope 3 emissions are accurate, reliable, consistently available, and complete. In the past, so if you think, 10, 15 years ago, companies could often make ambitious emissions reduction targets without much oversight on whether those goals were achievable or on track to be completed. Things are much different today now with regulations like CSRD and the currently paused SEC rule, which requires companies to prove that their sustainability targets are reasonable and determined using proper methodologies. As a result, a company's goals and target settings need to be centered around data that can be relied upon. The last bit of background I'll give on scope 3 is that, generally speaking, there are two routes you can go to calculating specifically your category 1 emissions, or as I mentioned, category 1 is the emissions as a result of you purchasing things from your suppliers. The first route is by using data that is already easily available to your company. This typically takes the form of costs in dollars broken out into various categories, or attributes of the raw materials you're using, such as weight or number of units purchased. You would then multiply the cost or weight or whatever else you're using times a publicly available emissions factor. This approach has the benefit of using data that is relatively easy to obtain, but has the drawback of relying heavily on assumptions and estimates. Just as an example, simply because steel from one supplier is more expensive than the steel you purchase from a different supplier doesn't necessarily mean that the first steel purchase causes more emissions. Emissions related to steel production can vary greatly depending on the supplier's manufacturing process. This nuance in terms of, what's the specific process your supplier is using, that nuance is gone when only using a data point like cost or weight. The second option to calculate category 1 emissions is to use data provided directly from your supplier relating to the specific product you're purchasing from them. This is the flip side of the coin from option 1. In this case, if the supplier provided data can be relied upon, it can lead to an extremely accurate scope 3 inventory, but the data is often difficult to obtain and requires a strong relationship with your suppliers. When your company decides to approach scope 3 through the first or the second method, both will need third-party verification to meet many regulations and to be considered reliable. I'll pass it on to Farheen to provide CDP's perspective on the importance of these disclosures being considered credible.
Thanks, Brady. So there are many reasons why credible disclosure can now be seen as a business necessity. There is a growing understanding of how climate change impacts businesses and financial institutions. It presents risks, but also opportunities. And in order to identify and understand those, credible environmental disclosure is needed. This is what helps businesses understand their environmental dependencies, impacts, risks, and opportunities. It also provides investors, financial institutions, and procurers the data they need to ensure their investments and contracts are aligned with their climate targets and goals. Businesses providing high-quality disclosure have greater access to capital and to procurement clients. It enhances their competitiveness and is an opportunity to improve their environmental performance through the information that comes to light via disclosures. And last but not least, it serves compliance needs, with mandatory disclosure requirements on the rise, which Brady will go into in a second. Third-party verification of the disclosed data enhances the reliability of the information, instilling greater trust among stakeholders who rely on this disclosed data to make their decisions. And that's why, next slide, please, Brady. That's why the CDP scoring methodology requires companies responding to the full corporate questionnaires to have 100% of their scope 1 and 2 emissions and at least 70% of a minimum of one scope 3 category verified with limited assurance in order to receive an A score. Handing back to you, Brady.
Great. So CDP's verification requirement, I think, does a good job of reflecting the trends that are happening around the world in various countries to have your emissions verified to some extent. And you can see this in this graphic that we've created here. Feel free to take a screenshot or use this for your personal reference. I know a lot of people have found this helpful. But this slide shows the timeline and what assurance level is required for each type of regulation that's come out recently. I won't go into each of these lines in detail, but the overall point is that having verified GHG emissions is quickly becoming the norm around the world and is shifting from a nice to have to a need to have. Even if your company is too small for these regulations to affect you directly, chances are that you will have customers that are caught up in these requirements, and as a result, will need your information to calculate their scope 3. You'll see noted throughout this graphic the reference to limited or reasonable assurance, and I'm sure some people are aware of the distinction, but one common question that we receive is, what is the difference between limited assurance and reasonable assurance? So just to briefly walk through it, a limited assurance is when me as a verifier or as an assurer, when we release our verification report, we'll say something along the lines of, this is just, in layman's terms, during our procedures, we haven't found anything that materially contradicts what is being disclosed by the reporting company. It's basically, we have no reason to believe that this information is materially incorrect. That's limited assurance, whereas reasonable assurance is where the assurer gives a positive statement of, KERAMIDA can confidently say that these amounts are materially correct. So it changes from, we haven't found anything that contradicts this information, to we are positively saying that there definitely is nothing materially wrong with these items. That with that distinction means increased testing and increased understanding from the verifier. And then it also means from the preparer. Typically it means, a more complicated internal control structure, more thorough documentation and review on your end. So that is the distinction. Currently, most regulations are focused on limited assurance with an eventual phase into reasonable assurance. And you can see that in this graph. This is some additional details on the currently paused SEC rule, which has been, a big topic of conversation for the last few months. So this is the currently planned rollout of verification requirements in regards to the SEC rule. So on this slide is just a few select companies that have issued sustainability requirements from their suppliers. So this really reinforces the fact that even if you aren't necessarily headquartered in the EU and you aren't affected by CSRD, you more likely than not have a client who is required to understand their supply chain, and your company will have to provide some form of data to meet your client's reporting needs. As Farheen mentioned, there's a huge benefit to getting your emissions data verified, and more frequently, one metric that these companies use to determine who their supplier is going to be is the availability of sustainability information. So yeah, this is coming from the top down, certainly. So in addition to simply complying with regulations, as Farheen had mentioned in one of her slides, verification can also provide a positive effect to your business beyond simply being in compliance. So verification ensures reliability of Scope 3 data. So as we had mentioned, more and more emissions targets are coming under scrutiny, and more people need accurate Scope 3 data in order to set accurate Scope 3 targets. You get increased insight into supply chain risks. So what companies are producing the vast majority of emissions? Are there easy cuts to your Scope 3 emissions based on what suppliers you're using? It ensures reliability of your GHG reduction targets. And then it ensures compliance with applicable laws and regulations. So I would say even if your company isn't necessarily in scope of one of the current laws and regulations, that is certainly the trend over the last 5 years, is that more and more companies are getting brought into the umbrella of needing verified emissions. So now is a great time to get a few verifications under your belt so that when the rubber meets the road, your processes are ready to go. And then steps to incentivize action throughout your supply chain. So in my experience, this is the hardest part, working with your suppliers to obtain the relevant information that you need in order to calculate your Scope 3 emissions. So number one, the first tip is to leverage your buying power to drive transparency. When you're looking at your Scope 3 emissions, the methodology that we usually encourage people to use is focus on your largest suppliers first. Where are the areas where you purchase the most from, where your relationship with the supplier is the strongest, where you can reach out to them and you have some leverage to get more of the data that you need. The second step is to set clear expectations and strategically engage with your vendors to drive action. So once you have collected all of your data, it's important that the metrics that you are going to be holding your suppliers up to is very clearly structured and thought out, and is very straightforward for your vendors to understand so that they can make the changes that they need to in your business to meet your needs. Number three, cascade science-based targets through your supply chain. It's extremely important when you're going through this exercise that you compare any Scope 3 reduction goals that your company has to the emissions goals that your suppliers already have. So a lot of times, your suppliers might already have plans to reduce their emissions by, let's say 30% by 2030. that's a really helpful data point for you to have, because then you can incorporate that into your model and you can say, okay, do we need our supplier to be more aggressive? Is that already more ambitious than what we were planning? And we can, that's like an easy win for our team. So you can incorporate that data in your emissions reductions targets. And then finally, join forces to accelerate action and build momentum. There are many industry groups. I just heard of one related to the cosmetics industry the other day, where companies within the same industry are getting together to approach suppliers as a group to get the information that they need. So a lot of times companies in the same industry will all have the same suppliers. So it makes sense to approach them as a group, where as together you may have more leverage than just an individual company. So hopefully all of this information was helpful. We touched on a lot of different aspects, primarily how verification is helpful from a regulatory perspective, how verification is helpful to retain clients, but then also, like Farheen mentioned, it gives you further access to capital and allows credible data for you all to better set emissions targets in the future. So I want to thank you all for your time, and then leave a few minutes for Q&A to answer some questions. Well, in the meantime, as people may be typing out questions, one item that I know I would love CDP's perspective on is when it comes to the questions that companies answer in their CDP report. Farheen, could you give some detail on where companies disclose the details of their emissions and what targets they're setting in verification, if I'm looking to get an understanding of what goals my supplier has set out?
Absolutely. So in the 2024 questionnaire, which if you've seen has had a lot of change compared to the previous questionnaires, because it's now an integrated one, combining all the big three themes, but more, that CDP in the past had separate questionnaires for. But so in this year's questionnaire, information about targets, emissions, and verification are all in the environmental performance module for climate change, which is module 7. And the questions requesting verification have actually had no change from previous years. So we are collecting the same information, which is, it's good for consistency. And the questions on emissions and targets have been modified, and the details of those modifications are available in like changes documents on the CDP website. But yeah, they're all in the environmental performance module. I can see actually now we have a couple of questions in the chat. Would it help, Brady, if I read them out and you go from there?
Yeah, sure.
So we've got a question: how many of your top scope 3 suppliers should be evaluated when you start?
Yeah, so that's a really good question, because it can be very overwhelming. I mean, some companies will have thousands upon thousands of suppliers, and it's obviously not realistic to reach out to all of them. So I would say, typically what I would suggest is to do an analysis, number one, based on spend. So typically, I mean, every business is different, but if you're able to identify, like, for example, a client just last week, like 10 suppliers made up 70% of their spending. So that was an easy analysis to do, to say, hey, if we focus on these top 10 suppliers, that's going to make up the vast majority of what we purchase. An additional analysis you can do is looking at just the general emissions intensity of your various clients. So if you use, like raw steel or concrete, those are like two very stereotypical heavy emissions industries, that's a good sign that those suppliers are going to have an outsized impact on your emissions. So those would be the important suppliers to reach out to first. And then obviously, as you get better year over year over year, you can kind of reach out to more and more suppliers. I'll go back really quickly to this slide here. Use of internal data versus use of supplier data. Most companies will start their scope 3 journey in the first method using internal data, and then slowly over time, again, focusing on their largest suppliers first and working down, we'll get more and more supplier data to increase the accuracy and quality of their scope 3 emissions accounting. So it's an ever evolving process that is improving every single year. So hopefully those tips answer your question, Cindy.
Thanks, Brady. And I can take the second question here on, can we still perform well in the CDP survey if we haven't yet started measuring scope 3? To that, I'd say, I mean, the CDP questionnaire does take disclosures on a journey. The obviously definitely one outcome and benefit of the disclosure is to make that data available to decision makers and access the benefits that I kind of went through in the slides, but it is also a learning experience, and we've noticed a trend in how well companies perform in the disclosure over years of tracking. So by disclose, like, the questions are designed in a way that prompt thinking about what actions need to be taken within an organization to then be able to disclose that information. But specifically about scope 3 is certainly very important, and it is a huge chunk of the emissions of an organization's carbon footprint. But scope 1 and 2 are also very important, and it's understandable that scope 3 can sometimes be difficult to get right. How well, like, I can't definitively answer how if companies can perform well, because how well exactly as well. But and also we have a very detailed scoring methodology on the CDP website, and I definitely can't condense that into just whether the emission of scope 3 would impact the score or outcome significantly. But I'd say that it's not like more important than everything else. If you do well on disclosing on the other elements and targets and scope 1 and 2, that is a very good place to start, and it would still enable you to do well and take the right action, and also put you in a better place to then build up to being able to measure scope 3 and then disclose it as well. I hope that answers your question. And I know there was an earlier question on whether these slides will be available offline. Certainly this meeting is recorded, so I think we can make this available and send the material over afterwards. But yeah, thank you so much.
Great. Well, we just had time, so I want to thank you all again for your time today. Feel free to reach out to either my email or to the general, if you follow the QR code that leads to KERAMIDA's website, I believe. And thank you again very much. Hope to hear from you all, and have a good day. Thanks, Farheen, as well.
Thanks, Brady. Thank you all. Bye.